Hi, this is Craig, the options linebacker. This is the weekend report for Sunday, August 22nd. We'll start off looking at the Dow on the left, the transports on the right. These are the two components of Dow theory. They're both making higher highs and higher lows regardless of the recent pullback. So both of these are still in a primary uptrend. However, if we start making lower lows, in other words, if this takes out the prior swing low, then all bets are off. Now looking at the growth indices that pulled us northward through most of 2009, including the Russell with about 100% gain. We're looking at the NASDAQ here, the Russell 2000 small caps. Neither of these two took out the prior swing high on the July rally, so these are both weaker and nasty pullback coming down to a double bottom there, so very, very fragile, as well as the Russell 2000. This is very similar to what we saw at the end of 2007 before markets erupted into the bear market, is that the Dow was blasting higher and the Russell was making a lower high at the same time. That's not necessarily a leading indicator, but it does say that the investors have gotten to be much, much more defensive when they're piling money into the Dow. So now we've looked at big caps, we've looked at small caps and technology. Let's take a look at the S&P 500 starting with a monthly chart. The S&P has gone from a higher high to a lower low, and so far appears to be putting in a lower high at that 61.8% retracement. But for that to happen, the weekly chart has got to put in a lower high itself. Let's see how that's manufactured. Now this is one very confused chart because we had a very linear trend here, 5 waves to the upside, very classic, and we can make a case that we did see an ABC correction, so it's ready for the next impulse series higher. Well, this first wave higher petered out right around that 1130 level, so it's double topped, if you will. So right now all we're seeing is essentially just kind of a sideways move that's showing up on the weekly chart. But as we said on the monthly chart, what we're looking for is the weekly chart to start things lower by putting in a lower high, and this could be it. This could be it on the double top here. Let's move down to the daily chart and see if there's something that we see there as well. On the daily chart, we can see how the S&P failed this ascending wedge to the downside. They always do eventually. So now what we're trying to figure out is whether or not this is truly a lower high, including this little blip here. And this lower high will start to cascade lower, starting with the daily chart, unfolding fractally into the weekly chart, and then finally pulling the monthly chart down. The only problem with that theory is that right now we don't know whether this is just a pullback, so this could be the first wave up, second wave down, third wave coming. So this could just be a pullback for now, so what we have to watch is this zone right in here. So it's finding support at the 50% fib of the July rally, and it has not come down to the 62% retracement yet. On Friday, we finally filled the gap that was in the S&P futures down at this level. So that gap is filled. We don't have any gaps below us. This thing is ready to go if it wants to, if that's the way that it's going to go. So we're going to find out very quickly whether or not this is going to be the start of a new impulse wave higher, believe it or not, or whether this is going to be just like everybody thinks it is and start to head lower. Now that's the problem that I have with the lower theory right now. Everybody is looking for this chart to go lower, including people talking about the Hindenburg omen and everything like that. Normally when everybody sees the same move coming up, that's when it doesn't work. So let's shift over to position management and discuss what we're playing in the market. Now, we just finished the August cycle, and that marks the 12th straight month that we've made a profit. So if you're having difficulty getting in sync with this crazy market right now, give us a shot. Right now what we have in the high probability condors is we have a bull put spread down here at the S&P 960 level. Unfortunately, we were not able to get the matching call spread, even though it looks to be obvious, because what I did want to see was that strike at or above resistance in this level, because after all, we're coming out of a descending wedge pattern to the downside. We should have had an explosive move out of there, but we didn't. I gave this rally perhaps a little bit too much credit for potential, and I did expect to see at least a pop up to 1140, 1150, which never materialized. So we will dance with the one that we brung through the rest of this September options cycle. And one of the things that I talk about is that if we do go below the 62% fib, then I will take some more aggressive hedging action against a move lower, because I do think that if we drop below 1050 that we'll probably see S&P 1010 rather quickly. Something else that we do is the low probability iron condor. Now what's nice about this trade is that we are looking to make this vertical area here the same amount as that we're risking on either side of this. So as long as we can keep the price within this area, then we can make a pretty good profit and risking what we're looking for. So it's a 1-to-1 risk-reward ratio trade, which is great. The only problem is that this profit area is not very wide, certainly nowhere near as wide as the high probability condors. So we manage them very, very differently. What we typically find with these types of trades, especially with this type of market, is the price will go outside of the condor and then snap back, and will go above the condor and then snap back. We saw this on the last cycle as well too. So there's a certain element of reverting to the mean that occurs with price. One thing that's helped us with this strategy is that we don't sit through the entire month with the trade. What we're looking for is just a reasonable return on risk. So once we achieve that, we are out of the trade and we're looking forward to the next cycle. You can see on this trade right now, it's already up. It's already in the black right now, although not quite at our profit level objective that we'd like to see. So we have some good room to the upside that this trade can still run and become profitable by expiration, and a little ways to the downside that it can run as well too. But you can see that 1050 level there, if it holds as support, will help bolster that lower end of the trade. So far, nothing to do with this trade, and if the VIX comes in a little bit more throughout the following week, we should be able to take early profits on this trade well in advance of September expiration. Now, something else that we've done over the past year is say if you can't beat them, join them. We've been playing directional trades as well. It's certainly not the major focus of the newsletter, but it's one of these things that allows us to play a more balanced approach in the market is if we're also doing swing trades. So we do most of our portfolio with the iron condors. That is really our focus. That's our specialty. But if the charts are going to run and just go ballistic, why not participate in that swing? Why not participate in the trend that occurs as well too? Here's a couple of trades that set up within the last calendar month. At the end of July, we did enter a long trade, and this is based on the 8 and 21 period moving averages, showing a crossover. This was a false crossover here, and we knew enough to stay out of that trade because we would have been stopped out on the very day that we entered. This is our first valid entry. We took half profits up here as we got outside the Keltners and stalled. And then the second half of the position was stopped out here for about break even. And now with a recent retracement, there's been an ideal entry right up here that we took last week. And this is a short position, which we could also go long on the SDS to achieve the same thing. And currently we're out of half of the position and we're running the second half of it based on the trailing stop of the 21 period moving average. Now we do have several swing strategies that we look for, but right now this is the one that's doing the heavy lifting for us. And that's it for this week's edition. We'll catch you next week, folks. Take care.